Price moves in the direction that hurts the most people. If there was one thing to take away from today, it would be this. But of course, no one enters a position volunteering to get hurt, yet the market, as we have already demonstrated, forces traders to exit. So if we want to provide liquidity to those exiting losing traders, we want to know how the market does this. Yeah? Everyone agree with that? So to avoid honing in on every individual bar, we can filter our data by using a moving average to get an indication of what's happening. And in this case, we can conclude with this chart that there is a directional skew to the upside. So I'm sure everyone agrees with that. But what if we just focus on this area in here? So we've got a move overall that is to the upside, yet there's a great period of time when price is failing to move higher. So just imagine if you were long in this market and then you were sitting through this period. What would you be inclined to do? What do you think traders on the sidelines would be inclined to do? What's happening here is short traders are being enticed into the market because they become myopic in their view and lose sight of the bigger picture. And as we have seen, there is then an imbalance which causes rapid emotion-fueled price movement. Okay, so I've taken exactly the same chart and now overlaid the volume profile. Each one of these bars lasts for 30 minutes. And what we can see is that this period here, where price was, in inverted commas, no longer going up, as we discussed, enticed lots of traders to enter short. When you've got a whole lot of traders wanting to urgently exit all at the same time, you get this rapid price movement. And what you can see in the profile is there is actually not that much business done through this period. This is where all the trading was conducted. Same back here. But when price really started to rocket, there wasn't actually a lot of contracts traded. So essentially what I'm saying is price was moving, but it was pretty thin as all of the stop orders were spread out across many different price points. So however, due to the misconception among many traders that strong price movement is always correlated to high levels of volume, traders get sucked into chasing the markets, getting in at the highest points. Now who's done that? Seeing a market move really aggressively, thinking it's going to continue, and then you jump in, and as if it's almost perfect timing, the market then goes the other way. So the reason we trade with the directional skew is because those who fight it actually fuel its continuation. Now remember that saying, the trend is your friend. I actually never knew what that really meant. But when you think of the market in terms of agreement, lack of agreement, and also traders being enticed into taking trades in the wrong direction, you can understand now from that view before how it's actually those traders fighting the move, unbeknownst to them, that they're actually fueling its continuation.